Lately, there's been a lot of talk about the warning from Cathie Wood regarding the risk of deflation in the economy. In addition to that, we've been witnessing record levels of assets pouring into money market funds. This surge in liquidity is also finding its way into the bond market. In this discussion, we'll delve into these topics, examining the potential impact on yields and equities. So, let's break it down. First and foremost, it's important to understand what money market funds are. These are investment funds that focus on short-term debt securities, such as treasury bills and commercial paper. Investors often turn to money market funds for safety and liquidity. What's catching our attention is the sheer amount of money flooding into these funds. As of the latest data, total assets in money market funds are hovering just under $6 trillion. To put this into perspective, this is a record-breaking figure dating back to as early as the 1940s. The median historical value for these assets has been around $1.3 trillion. That means we are currently sitting at more than 4.5 times the median value. It's a staggering amount of capital seeking shelter in these funds. Even Warren Buffett's Berkshire Hathaway, as we learned from their recent earnings report, is holding approximately $157 billion in cash, with a significant portion in short-term U.S. Treasuries and T-bills. This move makes sense, especially given the attractive yields on these assets, which are currently hovering over 4 to 5%. But why are so many investors flocking to money market funds? Cathie Wood, the renowned founder of ARK Invest, has been sounding the alarm about deflationary risks. She points to the Bloomberg Diversified Commodity Price Index, which shows that commodity prices today are roughly where they were 40 years ago. This indicates a resumption of the deflationary trend that's been in place since 2008. Wood argues that if deflation becomes a more significant risk, pricing power will evaporate, and substantial wage hikes won't lead to inflation but will instead squeeze profit margins. In such a scenario, long-duration stocks and bonds are expected to be the biggest beneficiaries. These assets rely heavily on future cash flows, often spanning 5, 10, or even more years. As interest rates decline, the present value of these future cash flows rises, making them more attractive to investors. So, the core of Cathie Wood's argument is that deflationary pressures could drive investors towards these long-duration assets. However, it's essential to note that while Cathie Wood's perspective is critical, it's not the only one. Many other prominent figures in the financial world have differing opinions. For example, Jeremy Siegel shares the concern about deflation, but others like Ray Dalio are more focused on stagflation, where prices remain elevated for an extended period. Meanwhile, Bill Mann discusses the possibility of the economy slowing down faster than the data suggests. So, there is no consensus on the immediate direction of the economy. While some signals indicate softening in the labor market and a potential uptick in unemployment, consumer spending remains strong. Whether deflation or inflation will prevail in the coming quarters remains uncertain. It's a matter of time before we see which view holds sway. One crucial factor to consider is where all the capital parked in money market funds will eventually flow. The answer to that question lies in the dynamics of the bond and stock markets. In all likelihood, the initial movement will lean toward the bond market. This is because many investors will seek to lock in higher interest rates for more extended periods, be it 5, 10, 20, or 30 years. As long-term yields start to decrease significantly, investors are expected to transition their capital from money market funds to the bond market. This influx of demand for bonds will drive prices up and, consequently, push yields down. This may lead to a cycle of panic buying, with investors eager to secure attractive rates before they diminish further. Currently, yields are experiencing some upward pressure, and they are hovering at just under 2%. There is a strong support level at around 4.5% for 10-year treasuries, but should they drop below this threshold, it may trigger an increased influx of demand for bonds, further lowering yields. This demand for bonds is expected to benefit bond ETFs like TLT and TMF. As we observe the state of equities, they are still moving sideways within a downtrending channel. The S&P 500, for instance, continues to be rejected at lower highs. The Nasdaq, too, has shown signs of a slowdown in its rally. This is not surprising, given the market conditions, and it's important to keep a close eye on these trends. The question that remains is when and how these capital flows will impact the stock market. Right now, bonds are more attractive than equities from a risk-adjusted perspective, primarily due to their higher yields. Investors are enticed by the opportunity to lock in these favorable rates. But, as these dynamics evolve, we might see equities regain their appeal. The point at which equities regain their competitive edge depends on multiple factors, particularly the trajectory of yields. As of now, 10-year Treasuries yield around 4.6%, which, when adjusted for inflation, still offers a positive real return. However, if this number drops below 3%, and if inflation remains above 3%, we could witness a shift. At that point, equities may once again become more attractive, drawing in liquidity from money market funds. It's a dynamic situation that hinges on various factors, including economic data, inflation rates, and investor sentiment. For now, we are in a transitional period, and the path forward remains uncertain. As we navigate through this economic landscape, it's crucial to keep a close eye on developments in the bond and stock markets. The movement of capital from money market funds into these markets will have a profound impact on both asset classes. The key takeaway here is that as we witness this financial reshuffling, it's important to stay informed and be prepared for potential shifts in investment opportunities. So, what are your thoughts on the surge in money market funds and the potential implications for the economy and financial markets? Leave your comments below, and let's keep the conversation going. In conclusion, the financial landscape is evolving, and the surge in money market funds and Cathie Wood's warning about deflation risks are important factors to consider. The flow of capital into the bond and stock markets will have far-reaching consequences. Stay informed and be ready to adapt your investment strategies as the situation unfolds. Disclaimer: the views expressed in this content are the author's opinions and should not be taken as financial advice. Always conduct your research and consult with a financial advisor before making investment decisions.